What is going on, guys? It's Friday, July 19th. It's just after 11 a.m. CEI got a little pop today from $2 up to almost $3. I want to break this down for you guys and show you why CEI popped off today. It did not come out with any news, but if we look at a bigger time frame, a 30-minute time frame, this recently ran right here on July 9th. 10 days ago, from $2 all the way up to $9.50. And just like a rubber band, I just put the playbook play out, the rubber band play. I'll leave a link to that play in the description down below. CEI from $2 runs all the way up to $5, pulls back to $3.50, shoots all the way up to $9.50, pulls back all the way down to $3, pops up to $4, pulls back to $3 again, shoots up to $5.50, and then all right here, pulling down and down and down and down and down and down, all the way back down to around this $2 level right here. This $2 level gets a nice pop up to $3. With low float stocks, they are very volatile, and if a low float stock recently went on a big run like it did right here, on its way down, look for opportunities for bounces at key levels. Always looking at it on multiple time frames. You can see right here it topped out at $3. Why did it top out at $3? If you draw a line all the way just like that, this is the area where the stock did a 1 for 25 reverse split. There's also a gap right here. That's going to act as resistance and support for a stock. And also, this little area's right here, just below $3. Those are going to act as resistance levels as well. Always keeping in mind areas of interest. Where did the stock bounce? Where did the stock find resistance at? You can see when it sold all the way down right here and even gapped down right here down and it popped back up. Look at right where it found resistance at. If you draw a line from this gap right here, it found resistance about right there. But let's get back into CEI and its bounce today. We'll look at this on the 1 minute chart. CEI from $2.15 right here starts getting all this volume pushing into it, ramping it all the way up to $2.80. Don't chase after it when it's in the middle of a ramp. Let it top out, let it sell off. All you simply got to do is throw Fibonacci retracements from the low all the way to the high. I quickly just slapped on the Fibonacci retracements on it. This pulls all the way back and it bounces right here at the golden ratio on the fibs, the 61.8 level at 240. Bounces up to 245, gets momentum, and shoots up to 265. Pulls back, and what I like about this pullback right here is this doji right there. And it's also bouncing and holding at support at a key level, 250. It's at a key Fibonacci ratio, 50% retracement. This support area is holding from this old resistance right here. From 250, moves its way back on up to this 265 level, shoots over it right here, pulls back, confirming that this old resistance is holding as support, and it grinds its way all the way back up to the high here at 280. From 280, it flushes all the way back down to this 265 level, holding as support from resistance right here and right here. From this 265 level, grinds its way all the way back up to this 280 level, consolidating at this level, even buying at this level right here. That's a risky play in chasing this. This did cross over 280 and run all the way up to 294, but you've got to always look at the risk reward on this thing. Learn from the chart, prepare for the future. because history will repeat itself. And look what happened. The stock broke from this 280s level, grinded all the way up to 294, and look what ultimately happened. It held around in this area right here, and then it flushed all the way down to 265 right here, where support was right here, resistance, and resistance right there. This support area from 265 gets a nice 10-cent bounce up to 275, right back down to 265, right back up to 275. Now it's right back down to 265 again, creating a range. You see how these stocks like to move in stages, and you just got to break the chart down. It's also Friday. You got to take that into consideration too. We're approaching 11:30 a.m. on a Friday. The more seconds, minutes, hours that pass on a Friday, the more volume we lose. So you got to keep that in mind on Fridays. But you always got to look at charts as well, that market makers like to play games. They like to trick people. They like to play games. Like I said, you were chasing it right here and buying it. All they got to do is fake break it over this 280 level and flush it on you back to 265 or 250 and make you sell, and then they'll rebound it right back up. And then that's when all your emotions get triggered, and then you're forcing plays, chasing after it. You really just got to take a step back, let the stock do what it's got to do, and just listen to the chart. Go back and just put it all together. Draw Fibonacci retracements on it. Observe, look what it did. It topped out at 280. It went all the way down to 240. Look at areas, little areas that it struggled at and got above. And you'll really start to see hints of the stock getting put together, weakness and strength. One more thing I want to add in for you guys. I listen to a lot of podcast interviews with traders, and one thing that always stuck with me was I heard a trader once say that market makers like to play games. Ever since I heard that, I have always looked at charts differently. I've never looked at them the same after hearing that person say that market makers like to play games. Whenever I'm analyzing a chart now, I always keep it in my mind. All right, what game are market makers playing? You got to keep in mind that 90% of people lose money in the stock market. I want to think the opposite of them. And when looking at charts, I always want to try to visualize and see, all right, what if I was a market maker, what would I do to screw over people? That's what I got to keep in mind. Just like when the stock came up to this resistance right here and it crossed over a little bit, everybody else is thinking buy, 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 because it's breaking out. If I was a market maker, I'd flush it all the way back down and let everybody's emotions get triggered and sell, and then I'd bring it right back up. And that's what happened. And then look at, he slowly grinded it all the way up to $3, hung around $3. People are still chasing it and chasing it with all this just big volume down here. And I'm a market maker. What do? I flush it all the way back down to the same levels right here. And then I'll just pop it up a few times. And then I'll give another little quick spike. And then I'll rip it right back down. And then I'll slowly grind it right back up. It's all games. You got to tell yourself that. Like I said, as soon as I heard somebody say that, I've never looked at charts the same. Whenever I'm analyzing charts, I always try to put myself in the shoes of the market maker. What's the market maker looking to do? Because they love playing games. They love playing games. Sure, sometimes they'll just say, screw it, let them have fun. And just let the stock rip and rip and rip and rip and rip and rip. And have the ticker become an ATM. A lot of other times, you'll see the market makers playing games, and then they'll bring it right back up to the level. And just so all you doubters out there that don't believe me, I already have it brought up to show you guys. I entered in how market makers make money. And right here, market makers make money. The difference between the price at which a market maker is willing to buy a stock, the bid price, and the price that the firm is willing to sell it, the ask price, is known as the market maker spread, or bid-ask spread. The market maker makes money on the spread. So if a stock is on the bid at $100 and on the ask it's $100.05, that 5-cent difference is what the market maker is making. The more liquid the stock is, the tighter the spread is, which means every transaction that happens, the market maker is making money between the spread. So if a lot of volume is in on a stock and it's got a really, really tight spread, he's going to want volume to keep coming in and in and in and in and in to make money. And he also provides liquidity to their own firm's clients, for which they earn a commission right there. They earn a commission on transactions. So when you got stocks that are trading, they got a lot of volume pumping into them, they're going to be wanting to play games. They're going to rip the price down, sell it back down to support, and then build it all the way back up to resistance. That's why you'll see a lot of stocks in range and all that. If you don't really know about it, you gotta learn about it. This is why you're a trader. You gotta learn about everything as a trader. Open doors. The deeper you dive in to the stock market and day trading, the more you're gonna learn and the more edge. That's what you want, an edge over other people. That's why we call all the new people sheep, because they don't know nothing. And the more time you stick around, actually day trade and learn about this, the more you're going to learn and the more edge you're going to have. You have to know about market makers and how they make money. And once you learn about how market makers work and how they make their earnings and all that, then you'll start to look at charts differently. This is part of the reason why I don't use stop losses. Market makers make money on commissions of every trade. And what are they going to do? They get to see all your stop losses. So what are they going to do? They're going to rip the stock down, blow through your stop loss, and then rip it right back up. Because then your emotions are going to trigger and you're going to say, wow, I just got out, I want back in. And you're going to get emotional and you're going to buy back in, creating more money and liquidity for the markets.